Is drinking raw milk safe like RFK Jr. suggests? Can you reduce a glucose spike if you eat your food in quote unquote the right order? I'm registered dietitian Abby Sharp. I host a nutrition myth busting podcast called Bite Back with Abby Sharp. And those are just some of the questions I tackle with qualified experts on my show. There is so much food misinformation and disinformation out there, and it can feel impossible to know what's real and what's BS. On Bite Back, my goal is to help listeners create a pleasurable relationship with food, their body, and themselves, which in my opinion is the fundamental secret to good health. Listen to Bite Back wherever you get your podcasts.
Frequency Podcast Network. Stories that matter, podcasts that resonate.
Well, we've reached the midpoint of the year, and what's going to happen next with interest rates? It should start to get very interesting. Both the Bank of Canada Governor Tiff Macklem and U.S. Fed Chair Jay Powell, they've been talking recently about all of the uncertainty related to trade and tariffs as the main reason why both of them have held off on cutting interest rates. But the market is interestingly forecasting that rates might be coming down at the end of July, and that probability has actually been on the rise of late. Here at home, it's about signs of a weakening economy. In the United States, it might just be because of pressure from the Oval Office. Welcome to In This Economy. My name is Mike Eppel. Joining me on the line is Royce Mendes, the Managing Director and Head of Macro Strategy at Desjardins, to do some fearless forecast today. Royce, as we're getting into the month of July, the summertime doldrums. I'm not sure this is going to be the case this year because there's a lot going on economically speaking. Obviously, we're still in the middle of a trade war, which interestingly has been, from a headline standpoint, has been pushed a little bit to the side. But look, it's going to come down to when we start seeing the actual downdraft that many expect in the domestic economy, the trade implications and how that plays out. Recently, we had the inflation data, which again showed pretty soft inflation headline-wise, but core was at 3%. What was your takeaway from that? Because it seemed to be a really very much a mixed reaction and what economists were thinking it meant for interest rates going forward.
That's right. That's because it was a bit complicated to dissect. But if you bear with me, I promise you I'm coming to a conclusion. If you look at the headline rate of inflation, as you mentioned, it's quite soft at 1.7%, below the Bank of Canada's 2% target. That is actually the rate of inflation that the average Canadian has felt over the past year. Now, the Bank of Canada will say we need to ignore that because it's impacted by the removal of the consumer carbon tax. And so they look at these core measures of inflation. And what they're trying to do is get a reading on the underlying pace of price growth, because that's really what they're trying to control. They're not trying to control for what's happening today. They know they can't change whatever's happening today. They're trying to understand what the pace of price growth is so that they can try to control it in 6 or 12 or 18 months into the future and get it back to its 2% target. Those core measures are hovering around 3%. So you would assume that, most analysts would say that's too hot for the Bank of Canada to be cutting rates. But I will argue that if you really look at the details, and we spend almost too much time cutting and slicing that data in all kinds of different ways to figure out what's really going on, you will find that it is being impacted by some very weird things that happened in April. All of a sudden, rent prices skyrocketed in April, even though most measures of market-based rents or asking rents have been falling across the country. I find that odd. Another thing is that you saw a lot of increases in what I would call tariff-exposed sectors. So the auto sector, there were food categories that saw outsized price increases, furniture, appliances, all of those things saw outsized increases in prices. And while the governor seems to think that we shouldn't have been seeing price increases just yet as a result of Canada's retaliatory tariffs, I would argue that consumers did face some increases, and that might have been some retailers front-running what they expected in terms of their cost increases. Right. And finally, what we saw was, as some people around the country received a benefit from the lower or the elimination of the consumer carbon tax, some companies who sell energy to households actually raised their margins a little bit. And while the tax implications are not contained in core measures, the increase in margins is contained in those core measures. And when I look at the whole distribution of price growth in April across categories, I would just use one word to describe it, and it is strange. I would not call that a representative assessment of what's actually going on. We got the May numbers, and the May monthly numbers on core inflation looked, number one, a lot cooler, and what I would say a lot more normal. And that is where I am taking more signal. The April numbers I would call noise, but they're still impacting the year-over-year numbers even in May. But the May month-over-month numbers are really the signal that I'm seeing. And if the Bank of Canada is willing to look past some of the strangeness in April, I think they'll find that Canada doesn't really have a core inflation problem. I think that what happened is maybe statistical volatility in April. It could be tied to tariffs, which should be almost one-time or very short-lived in nature, or it was tied to the one-time elimination of the consumer carbon tax and the way that impacted core versus headline inflation. And for those reasons, we think that the Bank of Canada should be gearing up and to start cutting interest rates and easing monetary conditions once again in this country.
Well, I think though what you just said in a very conclusive way is the fact that, and it backs what Macklem has been saying, that they're seeing, or they haven't yet seen, the full implications of tariffs. There is, like you call it, there's a lot of noise. We're all, add to the mix of the carbon taxes out. And then there was other things about, like, airfares were up, they were down, they were sideways. Yeah. I don't know. There were all these different little nuanced statistics. One thing I will ask, though, is when we talk about the elimination of the carbon tax, and before we get into more about interest rate policy, has that have any spillover effect on other baseline prices? In as much as all of the talk with carbon tax from retail was, or grocery stores, it's costing us so much to transport goods because of the carbon tax. That's out of the system. Is that showing up at all, the removal of that for other price points that may be affected by transportation costs?
I would say potentially yes, but more marginal. I think the biggest impact to consumers is, as you would say, as you pointed out, is the direct impact. So from lower fuel costs for their automobile, or to heat or cool, lower energy costs to heat or cool their home. That's where they're seeing it the most. The price changes in food, let's say, for example, which does involve a lot of transportation costs, have been so volatile recently as a result of retaliatory tariffs, the impacts of some climate events, that I would say it's very difficult to conclusively say that we're seeing anything actually play out in those areas of the CPI basket.
Okay, so between now and July 30th, which interestingly is the same day again the Fed.
Not ideal for people in your business or my business.
It's going to be busy. But look, we've still got data points between now and then. Another inflation update, which will really probably clarify things a bit much more. But, from a central bank's perspective, everybody's talking about, okay, the housing market is, pretty weak right now because of all of the uncertainty. The auto sector, the manufacturing sector, all this, we kind of see it coming. Do they not see it coming? That they should be proactive, I suppose. That's kind of been the argument, for why they should maybe already have been cutting interest rates.
So the Bank of Canada's argument on this is that they want to be less forward-looking than is typical, because you're absolutely right. Typically, the Bank of Canada is looking ahead to what the economy is expected to be doing 6, 12, 18 months from now, because that's the way changes in interest rates work. But in this environment, when things are changing so drastically from day to day, at least they were changing very drastically from day to day in and around April, they want to be less forward looking. So they haven't been willing they weren't even willing to put out a forecast at the time of the last monetary policy report. It will be interesting to see if central bankers revert to the policy of having a forecast and setting monetary policy via that forecast. If they do, I would argue that to your point, the labor market looks weak. The housing market at a national level looks weak. Look, I'm not saying that it's weak across the country. There are places, I was just in Edmonton, Alberta's housing market is actually doing pretty well. But the really big markets in BC and Ontario are doing poorly. And I would say haven't been struggling this much in some cases, in some regions, in decades.
Yeah, there's a lot of pessimism, I'd say. Like, it's just people just don't want to buy. And again, with real estate, it's location, all that, and the condo market's getting crushed, all these kind of things. But
and
a lack of confidence.
And a lot of households are still going through the mortgage renewal process.
Right.
So they are now renewing 5-year mortgages that were taken out when rates were very low during the pandemic, and they will see big changes in their payments. Generally, people, if they have jobs, they'll be able to absorb those, but they might have to pull back on spending in other parts of the economy. And your spending is my income, my spending is your income. That's the way GDP works. And so that's going to cool off the economy further. And so that's why I would argue that if they're really moving back to that forward-looking type of policy making, they should be thinking very seriously about easing monetary policy from the current level of interest rates, which they themselves have labeled almost neutral. They're not stimulative. The interest rates have come down a lot from their peak, but the Bank of Canada, we as well would agree that these are not stimulative interest rates, but the economy is not at full health. And so maybe it does need some stimulation. Maybe it does need some medicine, is the way we're thinking about it. What's been holding them back has been this sticky core inflation. But if you really think about the fallout from all of these tariffs and retaliatory tariffs, just look at the U.S. The U.S. has raised tariffs from very low levels to very high levels on a number of its trading partners. And we continue to see every month of CPI data that really the tariff stuff is not showing up in any big way. And so, I'm hopeful that whatever tariff-related price increases that do show up in Canada, they turn out to be very short-lived in nature, particularly because the rest of the economy is so weak, and it would be really hard for things that should be one-time price level shifts higher to turn into organically sustainable inflation the way they did during the pandemic.
Well, the other factor too is, if you've got an economy that is also, one of the pillars they say is consumer spending. I don't think consumers are spending as much as they were, and we've had the decimation and bankruptcy of Canada's oldest retailer, the HBC. Decathlon stores are closing in 5 malls in Ontario. All these things are real red flags, aren't they?
Well, you add to that the fact that population growth is moving from a sprint to basically a crawl. Government actions to curb the inflows and actually reduce the number of temporary residents in the country is working. From all of the data that we monitor, we can see it working in real time. And the population barely grew, if at all, in the first quarter of this year. And we tend to think the high frequency indicators suggest more of the same is happening in the second quarter. And so if people individually are pulling back, or households individually are pulling back, and you have less growth or no growth from population, well, then think about it from the perspective of businesses. It's going to be really hard to grow sales this year. And so, again, we come back to the point, what can help? Well, the Carney-led government has made some big announcements on defense spending, infrastructure spending. Those things will help the economy, but they take time. They take a lot of time. What could help in the near term? Lower interest rates.
Okay, let's change the focus and look to the States, because I have a feeling that if the Bank of Canada had been cutting interest rates, U.S. President Donald Trump would have been freaking out about it and yelling even more at his central banker to cut rates, because that has been Trump's go-to insult generator almost on a daily basis, where he's calling, for interest rates to come down 1 to 2%, and then he calls Jay Powell every name in the book. We won't necessarily repeat some of what he says because it is incredibly derogatory. And at the same time, the Oval Office is, the Fed's supposed to be an arm's length, not supposed to be politically influenced. And yet that is all exactly what Trump is trying to do. And this new twist to the story that Trump might name Powell's replacement 8 months before Powell is actually set to exit, which, and he'll bring in, I heard Scott Bessent, for example, Hassan might be a nominee.
Mhm.
Governor Waller, who's already been talking about, oh, he should be cutting interest rates. So there are already, doves in the Fed. So what do you think about it? Does Powell does he bow to pressure, you think, at the end of July?
Be extremely surprised if Jay Powell did anything to indicate that he was bowing to this pressure. He seems like he entered the year ready for a fight for the Fed's independence. And that fight is ongoing. The Supreme Court, while allowing the president the executive authority to dismiss many individuals, did not explicitly give him the authority to dismiss the chair of the Federal Reserve. And so, as you're saying, he may try, instead of getting rid of him immediately, to name his eventual successor. And Trump will have an opportunity to name one new person to the board next year, and that person can then subsequently be named chair of the FOMC. What I would say is that a lot of the names that you mention, in any other context, I would say that they would be reasonable candidates for the chair of the Federal Reserve. Scott Bessent has a lot of experience in markets. Kevin Warsh was on the board, and Hassett has served in senior public policy roles for some time. The problem is, the question, I guess, maybe is, will markets accept that the central bank is still truly independent? And
or
if
would
not,
they just be seen as puppets, right?
exactly. And that's where I worry about a name like Bessent. It's not his ability to actually do the job. It's the worry that the market no longer views the central bank as independent, and they start to expect that the person in that role is just going to do whatever the president wants, which is lower interest rates, cause inflation. You're going to see treasuries sell off. You're going to see higher interest rates in the US. Waller remains the most interesting choice to me because he has been on the independent Federal Reserve. He is very much a thought leader on the board. And as you say, he has been dovish. He's been talking about potentially a July interest rate cut much earlier than most people expect. But he would still be seen as independent. If you have to believe, if one of us was sitting in the president's seat, he has to be the one that seems most logical to pick because there are concerns about his independence.
Well, Trump's argument has been that the Fed is basically hurting the U.S. by keeping interest rates high because of the debt. The debt servicing cost continues to roll and get more expensive by the second. And by not cutting rates, Trump wants them down 1% to 2%. I know it's completely unrealistic. I get that. But from a real estate standpoint, of course he wants low interest rates. That's where he made his money, right? But, and he argues that Europe's cut rates, 8 or 10 times, whatever. Is there any, is there an argument to me that the Fed could, cut a little bit? I suppose, they're not going to go
first of all,
a little bit.
Let's be clear. He's not wrong that because interest rates are high, the U.S. government does have to pay out more in interest payments and renews its maturing debt at maybe higher interest rates that it was originally issued.
But whose fault is that?
Exactly.
That's not the Fed's fault.
So the question is whether the Fed is doing the right thing. To me, it's not clear that the Fed is doing the wrong thing. And I will say that it is important that the Fed's independence not be questioned. And so I would say that if the Fed was doing exactly the opposite of what the president wanted just because they wanted to appear independent, well, that would be wrong. But it should also not be the case that the Fed is doing just what the president wants because the president wants it. And in this case, I believe that the Fed is trying to find out what's best for the American people. And so I don't question the motives of the Fed, but I do think that there probably is an argument for interest rates to start to come down very soon in the US, assuming that the tariff fallout on consumer prices remains contained and limited. That's a big assumption, but if it does, then I think you could very quickly see a return to rate cuts, multiple rate cuts potentially from the Fed.
Do you think some of this too has to do with the budget that Trump is trying to get passed? In as much as the forecast is it's going to add trillions to the debt, not cut spending. But if you lower interest rates, does that take some of the pressure off on that end?
I think it takes some of the pressure off, but I really think that the U.S., even aside from the one big beautiful bill, as it's called, is just a part of the problem. The U.S. is fundamentally on an unsustainable path. And, we sit here in Canada and we do complain a lot about deficits, provincial deficits, federal deficits, but we should look at where we are relative to the US, or where we are really relative to other G7 nations. I mean, our general government, which adds up provinces and the federal government, the deficit, the starting point is the narrowest in the G7. And so we're really a strong point. The US is on the other side of that. And so adding anything more, you really have to question even more the sustainability. And now in this new environment, there are worries that global investors will not be lining up in the ways that they have been to buy this additional US Treasury debt. The US Treasury debt has always served as the safest of safe haven assets around the world. With some of the recent policies and the market reaction to those policies, some investors are thinking twice about how much exposure they really want to have. It's not that they're going to be selling their US assets or US treasuries, but maybe they don't want to add that extra marginal dollar of investment. And that adds urgency to the US budget situation.
Yeah, well, you mentioned the tariff tantrum, basically, where the bond yield spiked and treasury yield spiked there for a couple of days, and everybody was freaking out, and it made,
and the U.S. dollar declined.
Hey, listen, the U.S. dollar is still pretty weak.
Yeah,
it has been. It is not the de facto go-to right now by the looks of things.
And it's not even just the weakness. It's the fact that correlations are breaking down. Typically, when the S&P 500, the U.S. stock market index, goes up, you tend to think of risk on, and people will move out of the U.S. dollar into other assets. But if the S&P 500 is down sharply, people will pile into U.S. dollars because they want to hold safe assets. That's not been happening this year. Same with interest rate differentials. When interest rates were going up earlier in the year, as you mentioned in April, the U.S. dollar didn't strengthen. If anything, it was getting weaker. That is a sign that it's not behaving like a safe haven anymore. And that is very concerning, not only for Americans, but globally for the financial system, because any sudden stop would create extreme volatility. That's not what I think will happen. I think it's maybe a gradual shift away from having as much exposure to U.S. assets, but a sudden stop would be really scary.
Yeah, brand America has been damaged, let's face it. And not funny, but the interesting thing about that is even if the Fed were to cut rates, if there is a lack of confidence in U.S. treasuries, then yields are going to stay elevated. I mean, they can't just jawbone it down even if they wanted to.
I will say one thing, that over the past 10 years, the U.S. has really financed itself both in stocks, in equities, and in fixed income, in borrowing, because private investors around the world have bought U.S. assets in huge numbers. And why have they bought U.S. assets in huge numbers? Because the return relative to the risk has been so great. Everyone knows about the Mag 7 over the past few years, but even before that, the US was proving in the pre-COVID decade to really be very dynamic, very productive, and other jurisdictions were not proving to be as dynamic or productive, and that sucked in a lot of money. And so, maybe all of this volatility starts to fade and investors have very short memories and they look for returns. And if the risk-adjusted returns are high enough still, the U.S. could very well see inflows again. It's just, I think it's an open question whether first the volatility subsides, both in markets, but also just the policy volatility, tariffs on, tariffs off, some of the stuff with regards to other policies, but also with regards to generally the economy. Can it remain so far ahead in terms of its dynamism and productivity ahead of its peers? If it can and the volatility fades, well, we could be talking about U.S. exceptionalism again in the not so distant future. It's just one of the big questions we're all struggling with right now.
Well, listen, let's take a break for the Canada Day long weekend, and then July 4th in the States. We got a week and a bit to maybe exhale after what's been a pretty challenging and stressful first half of the year. It sure has. And we'll touch base again at the end of the month or thereabouts. Thanks for doing this today, Royce. It was good talking to you.
Thanks, Mike, for having me.
And that was Royce Mendes, the managing director and head of macro strategy at Desjardins. You've been listening to In This Economy. My name is Mike Eppel. If you have any questions or story ideas, you can email me at mike.eppel, that's EPPEL, at rci.rogers.com. On social, I'm at Epman, EPP, and you can find other Frequency Podcast Network content like The Big Story on the Seeker app or on your favorite podcast player. Please rate, review, and share. Thanks for listening.